Well, we've got the Dow up 12 days in a row, but with Alphabet and Microsoft having reported, and with Meta just about to, we're looking at the Nasdaq and seeing how that performs in the short term. We've got a renaissance coming through in Chinese equity markets, but can it last? Property stocks all the rage at the moment. We've got a market that's fixated once again on selling euros, and Blake and I focus on various trades around that. And we look ahead at a plethora of event risk with the Bank of Japan, the ECB and the Fed meeting very much in our sights. We are all risk managers. This is Trade Off. Well, good day. I'm Chris Weston from Pepperstone, and I'm going to be joined by Blake Morrow from Forex Analytics in 2 seconds. And there is a lot to discuss. We've got central bank meetings coming through. We've got Aussie CPI prints coming out in a few hours. We've got corporate earnings really ramping up. Yeah, it's all going on at the moment. Volatility is pretty low still, so the market's not really responding as realised volatility remains very subdued. But we'll see if that picks up given the event risks and potentially if there's a change in the script, we'll go through there. But talking about Mr. Script, let's bring in Blake Morrow. How are we going, Mr. Good Sir?
Mr. Script.
Well, I call you a different name. But yeah, how are you going, mate? Will?
I'm doing well. I'm staying cool, over here in the in whatever hemisphere I'm in, sweating my butt off. But it's all right. It's all right. It's good. Don't want to talk weather. I want to talk markets.
Yeah, let's talk markets, mate. Let's get straight into it. Let's go topical thunder.
What?
Yeah, I want to talk risk. Set the platform. We've got the Dow is up 12 days in a row. I think in 2017 we got 13 days in a row before we sort of came off. I know people are sort of looking up at the casino board, the roulette board, and saying, there's 12 reds. The next one's got to be a blacker, so to speak. And I think, there must be a few people looking to get a little bit short for a little bit of mean reversion on the back of that. We'll see. We've got numbers just coming through from Microsoft and from Google or Alphabet. Alphabet's numbers actually look pretty good. The stock's up 7.6% after hours. Got Meta in the session ahead. And then obviously we go into next week, we've got Apple and some other big names as well. But we're getting through to the meat of earnings season. I think 26% of stocks have reported so far, 80% have beaten on the EPS by an average of 6.4%, those that have beaten, and 56 on the sales number. So earnings are all right, and then we've got central bankers coming out this week. I wonder if we're going to see anything that's going to change the market pricing and create volatility coming forward. But equities look pretty firm at the moment. People are still buying dips. Some of the European data started rolling over, which makes us, I know we're going to talk a lot about the euro today. If I look at S&P volatility, realised volatility 1 month, realised vol, it's about 8.8%. It's very, very low indeed, and that suggests to me that selling rallies in the VIX is still probably the right trade. We're not going to get that vol explosion until realised vol starts pushing a little bit higher. But you've got real rates holding in. Inflation expectations started moving up a little bit. What are you seeing at the moment? How's your bias at the moment? Are you buying dips? Are you selling rallies? Are you staying long? How's your sort of risk bias at the moment?
It's actually quite neutral. I'm going to bring up some charts that I think garner not only yours but everybody else's attention, especially even when you start talking equities. But I'm pretty balanced right now, and I'm actually pretty hedged. But I know this is a big week, and I think the risks are that the markets have been, just really not paying attention to what the Fed has to say as far as where rates are going. And I think, if the Fed and other central banks, which we're going to have discussions about, really start talking about rates, where they're going to stay and they're going to stay here longer. I'm wondering if that's finally going to hit home with the market, especially after such an elongated run. We're not quite at, we're almost at highs of the year. We're not quite at all-time highs, but we're not far off in many markets. And you could argue that some markets have been surging to all-time highs or close to, like if you talk about maybe like the German DAX or the Nikkei. So, I think earnings are still a big deal. We still got, some really big names coming up. This week, we just got past, some earnings today, which we'll talk about a couple of those stocks here in a bit. But I think there's still some risks out there. And I look at the bond market, and the bond market's kind of sideways. It's like it feels like the calm before the storm, Chris.
Yeah, I just showed before we go on to the ECB and Bank of Japan. I mean, I think the US data is still hot. Consumer confidence was a 2-year high yesterday. I mean, we've got this kind of immaculate disinflation, which is supporting equities, I suppose. That the fact that the Fed are reducing inflation and raising rates without causing any kind of major economic fragility. And we're seeing that in Europe with economic fragility there. And China's data is still pretty low. But I think the US data is holding up despite 5.25% inflation, Fed funds. And so I think for me, if we were to see inflation expectations kick up, realised inflation kick up, that would cause, I think, gyrations in markets. But I think it's really down to the data. As long as the data in the US is holding up and giving us a soft landing approach, then I think equities are holding. When that starts rolling over, then I think we start de-risking and we get a bit better shorting opportunities. So I think they're the focus. They're the 2 points. What happens with the data? What happens with inflation? I think that's where the equity market's keying off.
All right. Well, we're gonna shift over to the couple central banks that I think need our attention, which is the ECB and the BOJ. But before we do that, I just need to say that we are bringing up some commodities today, and I know you brought some charts with you today. Between that and China, remember we do have PCE at the end of the week, which might actually move the markets a little bit as well. So, yeah. So that is on Friday. But let's talk about the ECB and the BOJ. And I mean, my question is to you: which one's the more interesting meeting? Now, first, I'm going to say that the more interesting meeting to me is going to be the BOJ. The BOJ, they used their sneak attack, and the sources, those sources that no one can name, official sources, decide that YCC, there's not going to be any change in policy this week. It moved the markets late on Friday. It was actually late Friday for Japan. While I was sleeping, you were probably awake. Stopped me out of some of my yen trades. But, I think that move was by design personally. And I said this in my week ahead video that I talked about the BOJ positioning itself. So, because they don't want everybody front running a policy change. So I believe that if we're trading at 142 in the dollar yen or close to versus 135 or 136, if everybody's front running it, the movement that you see over the next 6 months is going to be much different, if they do start tweaking YCC this week. So I believe that the BOJ is going to be the more exciting meeting, but I don't want to take away from the ECB either, because I think expectations are pretty lofty based on some of the data that we've been getting from Europe. So which one of those two central banks are going to be your more important ones?
Well, the most important thing is what the market thinks is going to be the more has the highest propensity for movement, and they're saying the Bank of Japan. If you look at implied volatility in the options market, they're saying you're going to get a bigger move over the Bank of Japan in the ECB meeting. We're not expecting much over the ECB meeting. They'll raise rates 25 basis points. If anyone disagrees with me, you're wrong. Sorry, but the market's thoroughly discounting 25 basis points. Lagarde's pretty much explicitly said they're going to raise rates here. The question is how ambiguous they'll be about the timing of the next hike, and they'll be very vague indeed. The market's pricing in probably another one. By end of the year, we don't know when that's going to be. So they'll be vague and they'll say they're data dependent. The Bank of Japan, though, I agree. They've lowered expectations. But Ueda's come in, and he's got a slightly different mandate, I believe, to win credibility about their forward guidance. They had been predictable. They were certainly unpredictable in January. They were unpredictable in December when they actually changed YCC. No one was expecting it. So this is a bank where people are saying, well, if we are going to be shocked, it's going to be from the Bank of Japan. But I think Ueda needs to win credibility for his forward guidance. And given that article, I believe that they won't change YCC. If they were, there'd be a massive rally, I think, in both in the yen, and that's a risk. So I would be looking to reduce my exposures over that just in case. What if you can sleep well? I'll be probably sort of on a flight back from the Gold Coast on Friday, so I won't be able to look at those positions anyway. But that's it. It is a risk. I think what we'll see is the calm. I don't think there'll be huge changes, and most people are now expecting those YCC changes to happen in October. But it's a risk, and the market's saying they are hedging that risk through the options market. You can see that. So I think the Bank of Japan is the big one. If we are going to get movement, it's going to be coming from there. So we'll see what happens there. I want to bring up the Fed meeting because that's going to be coming up in the session ahead. For me, Blake, they raised 25 basis points. If anyone disagrees with me, you're wrong. The market's 100% pricing that in, or nearly 100% pricing in. That is, that's discounted now. The Fed have had a chance to push back on that. They didn't do that. The market's saying they're going to raise. The question then is, when do they? We know that they've got one more dot left in them, one more hike left in them. Do they give any kind of clarity as to when that's going to be? The market's saying at the moment we're going to get a hike in July or tonight. The question is that we've got about 40% chance that they raise by November, and that's them done. So they're going to be very much data dependent. What happens with core PCE this week? What happens with the CPI print on the 10th of August? All these factors will determine whether they look to raise rates in probably in November, if at all. So they're going to. So they raise rates tonight. They give a view that they're not done hiking. They're not going to give victory laps at the moment, because I still believe there's a lot of people who think that inflation could ramp up again, but due to base effects into the back end of the year, and therefore, they'll be vague, pretty much like the ECB, I suppose. So they'll not do victory laps at this stage. I think this is one where they'll be pretty vague, but give some positive thoughts that inflation has come down, in line with their expectations. So, is this going to be a dollar volatility event? Not sure where the risks lie, to be honest. I think they're pretty much symmetrical. How are you seeing this one?
Pretty much the same, and that's why, hence my hedging. Now, the thing that I'm obviously no central banker, nor am I, have any reason to even think I would ever be one. But if I was, I'd just get it out of the way, raise rates tomorrow, and then raise rates in September, get it out of the way, and let monetary policy work its magic and see what the effects are, months down the road. Just kind of get it out of the way and then go to data dependency. Me personally, but you're right. September, November, we're not really too sure. But I think the real trick is going to be the dot plots and what Fed governors see into 2024. Remember, the market's still pricing in how many rate cuts, Chris, in 2024?
If you're going to SOFR, which is the secured overnight rate in the futures, there we're pricing in about 130 basis points of cuts. They've come out of the market given the data, the better manufacturing PMI numbers, also consumer confidence numbers. But we are still, the market is saying that we are expecting rate cuts from around March and about 130 basis points of them. So.
Yeah, and I was thinking 125 is where my head was at, but here's the thing, I just don't think the Fed is going to be able to do that until.
No, I don't even.
What's that?
I don't. I think that pricing's too punchy. Yeah, agreed.
Yeah, I agree with that. And so, but the Fed's going to have to hammer it home, and I think the market has just not gotten the memo, and I don't know if this is going to be the meeting where they get the memo, but you would think, you would think that the markets start going, hey, wait a second, and maybe it has to do with the plots. And so, is it going to be a volatility event?
Well, it's an interesting one, Blake, because you've got Goldman Sachs who are coming out and saying that the last inflation number was a defining moment, and inflation's going to go lower, and there's real risks to the Fed's projection of 3.9% core PCE by the end of the year, and then you've got other economists who are saying that there's a real risk that we get inflation rising on a year-on-year basis from the September time because of base effects that are kicking in, and that's something that the Fed will have to deal with. So again, I know there's a lot of people who are watching this show today who are saying that the markets have been terrible at pricing interest rates. Whether you're looking at Fed funds futures or SOFR or Eurodollar when it was existing, the market's perennially got this wrong. They've got market pricing completely wrong in 2023 and 2024. Economists have got it wrong. And I think we've got to keep an open mind as to what inflation's going to do for the rest of the year. And therefore, could we get another leg up in year-over-year inflation? Who knows? Most people, the market seems to believe we're going to get trickled down. But I don't know. And our job as traders is not necessarily to forecast that. It certainly isn't to forecast that. But it's to trade the way the market's thinking and the aggregation of behaviours. So, we'll listen to what economists have to say. But at the end of the day, we've got to try and make money from the moves in the market. That's very different from what economists are saying, right?
100%, 100%. Well, hey, let's speaking of which, let's go to the last topic, and let's talk about China. As you mentioned last week or the last couple of weeks, the Politburo meetings that are happening in China. Look, China's. I think it's safe to say that their reopening fell flat on its face. They still, even though they're doing some stimulus measures to try to prop up their economy, and I'll tell you, you could see it, coming through commodities. We talked about cotton last week, that basing chart. It actually broke out the last 2 days. I know we're going to talk more about commodities. Crude oil's above its 200-day moving average. You got Brent moving higher. You got inflation that's probably set to move higher, and I don't know if it correlated so much with China and these stimulus measures, but they still cite that they have a lot of difficulties and challenges from domestic demand. And we've seen it in some earnings. I know we have LVMH might have just come out today. I think is this afternoon. I haven't looked yet, but then we had the Richemont Group last week, and there's spending is definitely slowing, especially on the high end of the Chinese consumer. But what is China going to do to really prop up their economy from here? Do we have, reserve requirement rate cuts coming? What do you think is coming? But it seems like it's feeding in the market. The market's trying to. You look at the Chinese markets, the CNH, the CNH 50, the China 50, trying to break higher. Hong Kong, Hang Seng's trying to move higher. What are your thoughts here?
Well, I thought that being long dollar CNH, the offshore yuan, was one of the best trades you could have in global macro. I was looking at the falling domestic demand, the fact that China was ramping up its role of goods in the world's economy, and saying, well, really, when you got this significant decline in global demand for these products that they've had, and they've shifted a lot of their employment into the manufacturing space. Really, the only way they're going to offset that is by giving the world purchasing power, and and that means a weaker yuan. And I thought that just was a pretty straightforward trade. The last couple of days, though, they've really pushed back on the yuan weakness, and whether that's superficial, just to make it look like as Yellen comes over to China, make it look like we're not going to continue to allow this devaluation taking place. Maybe it's superficial, but I thought and I can explain my thesis in greater depth in future articles, but I just thought this was just a pretty straightforward trade, not just from a carry perspective, but I thought that was the case. But I think that the Politburo have made it pretty clear that they've moved away from housing is for living, and not for speculation. They've removed that. The market's got very excited. There's other measures that are taking place, very targeted around the housing side of things. But we saw really good moves in Chinese equity markets, huge inflows through the Northbound Connect. The question is this a one-day affair, or is there a way of trading this right now, being long, the Hang Seng, or long the H shares, or the CN50, and short, European market, for example? Maybe that's a trade. We'll have to see. But I think I wouldn't necessarily be seeing a lasting bull market in Chinese equities because of what we've seen from Politburo. I still think there's risks. I think this Politburo meeting was above expectations, but not by a significant amount, and therefore I think there's probably a little bit more upside in Chinese equity markets, but not a lot, and so I wouldn't be going long based on this myself, Blake. Well, just a quick one before we go into the next section. What are you thinking on the Chinese equity side?
I actually think because domestic demand is dropping and it's hard for them to control that, I actually think long US dollar CNH at some point in the not distant future is probably still a really good trade.
Well, I do as well, but they've been talking about lowering the volatility and various factors, so it's not an easy one-way street anymore. That's annoying for us trend followers, but true. I still think from a fundamental perspective that let's talk in 2 months' time. You're going to see an 8 in front of the big figure there. I think is going to be the realistic situation. I think they know they need a weaker yuan.
They have to pull that lever, right?
But they can't make it look like they look like they need to push back on this, and they're doing that right now. So I think dollar CNH goes higher, and I'd be using pullbacks as a buying opportunity in my opinion. Anyway, let's move on. Let's go to that's the setup. Right, we're very, very Eurocentric today, and I think rightly so. Yeah, Euro's moving, and that tends to be where, that seems to be the sort of the light that flies Blake and I sort of gravitate to. A lot of traders, we tend to flock to movement. That's what we do. But I will start with Euro Aussie, and the reason I want to start with Euro Aussie is because, we've got a CPI number in Australia coming out in the session ahead. I think the market's pricing rates at 14 basis points, a 55% chance that the RBA raise rates next week, and obviously that CPI number is going to affect that. You've got the Aussie buoyed up by what they're seeing in China. I think that's probably the bigger driver, actually. So when we saw the yuan strengthen yesterday, we saw the Aussie strengthen in appreciation. So if anyone is trading the Aussie, you've got to keep an eye on the CNH. That is the absolute driver, more than domestic factors. But what we see now is you've seen that horizontal resistance level. There's been a number of fake outs that have taken place. We've got that negative divergence playing through. That's playing out now, as you can see. But it really doesn't want to close above, or it never wanted to close above that resistance level. And we're just seeing people looking to take those breakout strategies getting burnt time and time again. But now we're going down into that support level, down into the 162 area, 162.50 or so. Blake, question: how do we trade this? Is one for the scalpers to go long off that support level? Do we wait for the close there for a move down into sort of 159 or so? How would you trade this right now on that setup?
I'd play it off the channel support because it's a decent risk reward. Obviously, your reward's pretty well defined. In these markets, you have to also trade smaller positions, wider stops, because you have to compensate for false breakouts, false breakdowns. You can see it even on the upside there. But just a few days ago or last week. But I like playing it off the lows, and the reason why is because it is more of a risk aversion type of tool. And based on some of the things that I've been seeing over the last week, I think that we are on the cusp of getting a little bit of a pullback. And if we do in equities, I think the Euro Aussie could be poised to play right back up to the channel high. Yeah. So I'd be more.
So question for you, right? So when you're seeing a setup like that, I mean, obviously the setup is the setup. But you take this down into, say, 15-minute, 30-minute charts, and you trade the reaction off that level. So this gives you the oversight where the support resistance is going to be, and then you trade the reaction, right? So how would you take this daily chart and say, well, I'm actually now going to trade this? Are you going to what time frames would you take this down into?
I usually take things into a 4-hour time frame, okay. But what in this case, because we have Australian inflation data here very shortly, like literally in a few hours from the time of us filming. What I'd like to see is a move below that support and a move back up over that support.
Yeah.
So tell me that it's holding by the end of the session. So if I'm in North America and we dip below, I was just looking for the chart on my screen, just so I can see that horizontal support exactly where it's at. Oh, here it is. So if we dip right below the 162.30, and then let's say we even push some stops below 162 and we pop back up to 162.50. I'd be looking at in the next session. So going into Asia the next day, I look to buy dips from there. So that means I'll try to pick it up on 162.20 or something.
Yeah, I think this is an impossible one to forecast, and we don't forecast. We react in this situation. ECB, CNH, and Aussie CPI, you've got these cross currents which are going to affect it. It'll be interesting. Let's see how this the daily candle settles, and I think that will tell us a lot of information that we need to know.
Right. Well, speaking of the euro, let's go to my first setup, which is going to be the euro yen. You're playing the ECB, Bank of Japan. As you already know, I think that even if the Bank of Japan doesn't tinker with YCC, they are going to move up their inflation expectations, which will be moderately yen will gain strength moderately following the BOJ. But also regarding the ECB, I would, based on some of the economic data that we saw, and you could go even earlier this week and go look at the PMI data that came out. We had the German sentiment. We had
the European bank lending survey as well, which showed, I think, the biggest drop-off in bank lending ever or something.
Yeah, it was crazy. So you can see the economic data really sour. So I think the ECB is actually set up more for a dovish type of meeting. Yeah. I think that Christine Lagarde might be a little bit more dovish. Therefore, we've got a nice double top set up here with the euro yen. That means while we're below, and if we could get anywhere near in the euro yen. We could get anywhere near that 157.50 level, somewhere up there. I'd love to be on the short side up at those levels because you know where your risk is, and a move below the 50 DMA, it's your double top is in play, and you can look for a move down towards 140. So anyway, what are your thoughts here with the euro yen?
I think the risks are skewed to, fundamentally, I think the risks are skewed to the downside. I think, the market's pared back expectations of the Bank of Japan. Therefore, if they don't do anything, you're not going to see much of a negative reaction in the yen. I look at the CPI and their inflation forecast. That's a really interesting point you brought up. I think they'll look to raise them for this year to about 3.3.5% from what 2.8% was their prior forecast. The numbers for next year are probably more important though, because I can't remember what their forecasts were before. It was like 1.7%. But if they take them up 1.92%, I think the market, that would be a surprise, and the yen would rally. So all the risks, I think the Bank of Japan don't do a lot, but that's priced in. If they do anything, you're going to see a massive move in the yen. And I think you're right. The risks in euro, which are probably priced, is that we're going to get a slightly more than dovish reaction. So I think fundamentally it feels from a special situation that euro yen has downside risks. Into that double top neckline. So that's probably the way I'll be playing it. Let's go into crude, Blake, because. This is one that's been getting a little bit of attention from clients. And I think from a macro perspective, this is really important as well. I mean, the world seems to be catching up now to this sort of structural deficit that's taking place in the crude market for this year and also for next year as well. I mean, we're seeing increasing demand playing through, but also supplies obviously being cut back because of OPEC. And it's interesting to see, we get down to the sort of $67 level, which is where the US government have been saying they're going to look to replenish the strategic petroleum reserves, and that sort of coincides when OPEC look to cut back on production time and time again. It's almost like they're playing. The US government, the Biden government, in that situation. But we've seen, a really nice breakout, and technically it's doing all the right things. Obviously, a very strong trend that you've been seeing from $67. Now, from a macro perspective, we've actually seen break-even rates, which is your inflation expectations in the bond market. They've been pushing up to about 230 in 5 years. So what we've now seen is there has been a move in commodities. You've seen that in some of the agricultural and the soft commodities, oats, soybeans, all these factors. Cotton's been moving up a little bit higher now. OJ, then you go into nat gas. Gasoline's been on fire recently, and crude as well. And you've started to see inflation expectations starting moving up. That's a concern for me from a macro perspective, but from a trading perspective, can we get into these April highs here, Blake, or do you think this is probably a bit overdone now?
Well, I think while it's above the 200-day moving average, I think it's bullish. If you just take that last low that was at the very end of June and you just draw a trend line up the lows, that's going to keep you really in a trade from a bullish point of view. And I think you're right. I think this tick higher in commodities is going to be a real thorn in the side for all these central banks and for consumers globally. We're going to see inflation continue to ramp higher, and $80 is a big deal to me because $80 is 161% extension of the recent range. So I know that because previously the 200-day moving average was the 127% extension, 79, 90 something, 97 I think is the 161% extension. So I know that we're up against resistance, but I think you still have to buy dips in crude. I think
if you look at the futures curve at the moment, it's obviously in steep backwardation, and therefore people are incentivized to be long. You get the roll down in the futures contract, and again I think that sort of plays into buy the dips, and the fact that price is still holding above that 5-day exponential tells you that the higher skew is towards being long until we close below that level. So I wouldn't initiate new long positions here. If I was long, I'd definitely be staying in it. I certainly wouldn't be short right now. The risk reward is from the higher time frames isn't there yet.
Yeah. All right. Well, I'm gonna take you to my next setup. I'm gonna take you to Microsoft. I know last week I brought Apple. This week I'm bringing Microsoft, and you're probably thinking, what the hell? But I think this is a big deal because we just had earnings released just before we filmed this. Matter of fact, I took this image of the chart post market, and the stock was only down $3. Now it's down $15 or like over 3%. And it's actually below that support level that you see there. But this is a false breakout after hitting all-time highs. I cannot express to you all the importance of a false breakout after hitting all-time highs or false breakdown after hitting all-time lows. If you get a reversal, which checking out tomorrow, if we close below 340 and definitely get below that 50 DMA, you're going to see some selling come into Microsoft. There's going to be a lot of systematic selling coming into Microsoft. And Microsoft happens to be a big component of a lot of US indices. So keep an eye on Microsoft here. It looks bearish. They just reported earnings. The cloud computing earnings are, their revenues are coming down, but they're putting all their eggs on AI, baby, on AI. But
we'll see where that goes. In AI at the moment.
Right. So what do you think about this chart here, Chris?
Well, certainly from a fundamental perspective, you're right. Everyone owns Microsoft. I mean, it's been Microsoft and Apple and Nvidia have just done everything, haven't they? So this is a stock that is so loved, and they needed to come out and absolutely smash the bejesus out of expectations, and they didn't. I think the earnings were okay. Personal computers seem to be okay. The cloud side of things, I think, is right. That's where I think the market said, well, we've got to, they didn't absolutely smash it out on the cloud side, and I think that's where the stock is trading 3.6% lower after market. Revenue numbers for this quarter were good, better. This may be a stock that reverses, but I think what you're seeing in the price action there is a stock that is priced to perfection. They needed to absolutely smash it. They didn't. It was pretty much in line with some fragility in cloud. Now the question is can this go lower? Absolutely can. I'm not one that expects this to have a 10-20% decline. I think this is one that people will be looking to buy pullbacks in. But the significance of Microsoft on the broader index is real. So if you're a NASDAQ trader, if you're a NAS 100 trader or SM US 500 trader, you are watching the tape of Microsoft. And, I don't expect this to cause a significant drawdown. But I think a break of 340, you've got to respect that. So, Microsoft's a really big deal. I'm glad you brought this one up because I think, everyone's going to be watching this one.
Mr. Softy, that's the
Alphabet's
name of Microsoft.
So good. Alphabet's good, though.
Board.
Alphabet was good numbers. And Meta was up 1.7% after market. The market's implying movement of Meta of 8.6% in the session ahead. This is one that does have massive moves. The last 3 quarters have seen some outrageous moves in Meta. So this is one for the traders. Who likes a bit of volatility? I think they've already got that tailwind from Alphabet's numbers. Meta's the one we want to look at now in the session ahead. We'll see what happens there. Anyway, let's go to play of the day. Well, I'm going to go for a bit of Nat Gas. Now, the old Natty is one for the brave. If you're trading Nat Gas, anyone who's traded Nat Gas probably looks about 70 years old. They've aged very poorly, I reckon. It is one for where you just absolutely have to know your risk management. You absolutely have to know your position sizing and get your stops in the right place, or you will get blown out. So it is someone who does have that high risk tolerance. But what we've seen here, similar to what Blake brought up last week with the cotton chart, which I believe is now broken out. I'm right, Blake? Yeah. Okay. Good nod there.
Correct.
Right. So you've got this multi-month, this year-to-date consolidation. I know, we traded 290 down into sort of 270 or so. It's a decent percentage range, but you can see there that price has been moving sideways. And what we've now got is a consolidation. It's the ultimate Bollinger Band squeeze. So you've actually seen that realised vol, the price move, really coming in relative to that 20-day moving average. Now, which way will it go? I have no idea. But what I want to do is react when it does, because that concentration, that duration of compression is when you start getting that powerful move. Now, we know with Nat Gas, this has a propensity to trend. The trend followers are looking at this one, and trends start with breakouts. Now, breakouts often fail, and therefore you get quite low win-loss ratios on these. But when you're in there, you're looking for that outlier, that kicker, that 5, 10, 20R. And so I want to wait for a breakout and a close on that breakout, and I want to be involved in that because there is a really high probability, given the length of this, that this could trend, and I want to be in part of that. So this is on my radar at the moment. I'm not long, but just because of the power and potential of this trade setup, when it does complete and it breaks out on a closing basis, then I think this has the propensity to go on a big trend. So I'm looking at this one very closely.
Awesome. Well, have you ever played the pull my finger game with your kids? Because it's fun. It's fun.
I don't know. I just do it with my mates.
Okay. Hey, my play of the day is going to be the euro dollar. It's interesting. My colleague who I do shows with every day, Ryan Littlestone.
Oh, we know
he's
Ryan.
also one of the. Yeah. Hey, Ryan. He's on the Trade Off UK. The funny thing is his setup is playing the euro the opposite way of me. Isn't it funny? We're on the same team, but we're skinning the cat a little bit differently. But his expectations were different. He was looking for a more hawkish ECB and a more dovish Fed. So for me, I'm actually looking for a more hawkish Fed and a more dovish ECB. So the reason why this is key is because we are bouncing off the key 110.20 level. I've actually closed my euro dollar shorts from the last week. Now I'm hoping that we can trade up towards 111, 111.50 following the FOMC. And then I'm going to look to sell euros above 111, hopefully closer to 111.20, 111.50. And then I'm going to look for a move lower with what I anticipate is a weaker ECB. And I think the dollar is actually staging a bigger recovery longer term. Its false breakdown last week is a big deal. And I'm going to play into that, being long dollars on dips or short euros in rallies. So
I think
that's why I'm playing the euro.
I think you want to keep an eye on dollar CNH. I think, if the US dollar rallies against the yuan, I think that has big implications because the dollar will rally against the euro, against the Aussie, the Kiwi, all those currencies as well. So I think that's a cross that you need to have on the radar for your trade. Anyway, look, I've got you back. I know that the Team Ryan and Team Michael are bad people, so I've got you back here, Blake. So we'll see. Hopefully that works out in your favour.
Love you guys.
Anyway, hope anyone who stayed on for this show, hit the like button, leave a comment on what some of the action you've seen today. There's obviously a lot going on. Tell us how you're seeing the balance of risks, some of these event risks, and we'll see you back more for next week for more of the trade-off.